Global pension funds are staring down a massive $7 trillion funding gap, and this crisis has been brewing for decades. It's not just a sudden issue, it's the result of years of overly optimistic return expectations and risky investment moves. Pension managers thought they could keep raking in 7% or 8% returns forever, which was a total fantasy. They promised big benefits while collecting smaller contributions, creating a false sense of security. But now, the day of reckoning is here, and it's time to face the music. Back in the 1980s, corporate pensions were loaded with cash, promising guaranteed incomes for life. Fast forward 40 years, and most have disappeared, replaced by 401ks that shift all the risk onto employees. In the 90s, Japan had a pension system that everyone envied, but now it's a demographic nightmare, slashing benefits just to stay afloat. We've seen retirement promises crumble time and again, from corporate giants to entire nations, all driven by greed and denial. Here's the scary part. The global pension system is already deep into this crisis. This is the reality of how retirement promises die, and it's happening faster than anyone wants to admit. Global pension funds are staring down a massive $7 trillion funding gap, and this crisis has been brewing for decades. It's not just a sudden issue. It's the result of years of overly optimistic return expectations and risky investment moves. Pension managers thought they could keep raking in 7% or 8% returns forever, which was a total fantasy. They promised big benefits while collecting smaller contributions, creating a false sense of security. But now, the day of reckoning is here, and it's time to face the music. The 2008 financial crisis should have been a wake-up call, but it just made things worse. Central banks dropped interest rates to almost nothing, leaving pensions in a bind. To chase returns, pension managers took big risks, diving into high-fee stuff like private equity and speculative real estate. These weren't smart investments. They were desperate moves to recover losses. Promised high returns turned into higher risks and fees, leaving portfolios in a tough spot. Those high-risk bets have totally flopped when it comes to giving pensions the steady returns they need for retirees. Private equity and venture capital were supposed to be game changers, but instead they brought wild ups and downs, along with hefty fees and long lockup times. This isn't what pensions need to pay out monthly checks. Instead of reliable income, we ended up with a shaky portfolio of risky bets that created a false sense of wealth. Now, as central banks reverse course and aggressively raise interest rates to combat inflation, that fragile illusion is shattering. The easy money era that fueled the private market bubble is over, and the paper gains of the last decade are evaporating in real time. The same rising rates that make safe bonds more attractive are simultaneously crushing the valuations of the risky, illiquid assets that pensions are now stuck with. Suddenly, pension funds are sitting on a mountain of illiquid investments. Office buildings in deserted downtowns, shares in unprofitable tech startups, and stakes in private equity funds that they can't sell. They need cash to pay retirees, but their assets are frozen, locked away in vehicles that have no ready buyers. This really shows the flaw in their game plan, the denominator effect. As the S&P 500 dropped, private asset values didn't fall as fast because they're priced less often and with a lot of guesswork. This made private portfolios seem more stable than they actually were, hiding the real losses in the overall fund. It was just an accounting trick, letting managers act like they were managing just fine, while the whole ship was sinking, with the worst problems lurking out of sight. Compounding this financial disaster is a demographic time bomb. Retirees are living longer than ever before, meaning they are drawing benefits for more years than the system was ever designed to support. At the same time, birth rates have fallen, and the workforce paying into the system is shrinking relative to the number of retirees. This creates a fatal imbalance. Fewer workers are contributing funds while a growing army of retirees is withdrawing them for longer periods. It's a demographic pincer movement that guarantees insolvency, even if the investments had performed perfectly. The math simply no longer works. Public sector pensions are the most vulnerable, teetering on the brink of collapse. These funds, which cover teachers, firefighters, and police officers, have historically been the most aggressive in their use of optimistic return assumptions and the riskiest in their investment strategies. Because they are backed by taxpayers, there was an implicit belief that the government would always be there to bail them out. That belief led to reckless behavior. Now states and cities across the country are facing a brutal choice. Either divert massive portions of their budgets away from essential services like schools and infrastructure to prop up failing pension funds or default on their promises to public servants. Taxpayers are being put on the hook for decades of mismanagement and bad bets. The writing's been on the wall in the corporate world for a while now. Companies saw the crisis coming and switched things up big time. They've scrapped traditional pensions that guaranteed income for life and moved employees to 401ks instead. This shift puts all the investment risk on workers. If the market crashes, it's on them to figure it out. It saved companies, but now millions are left to fend for their own retirement. The unavoidable consequence of these underfunded pensions is that governments and the few remaining companies with these plans will face a series of painful, politically toxic choices. They can dramatically raise taxes on a shrinking base of workers, which would cripple economic growth. They can slash the promised benefits to retirees, betraying a generation that paid into the system their entire lives with the expectation of a secure retirement. Or they can take on mountains of new debt to paper over the gaps, pushing the problem onto future generations and risking a sovereign debt crisis. There are no easy answers, only different flavors of economic and social pain. In a last-ditch, desperate attempt to close the widening gap, some of the most underfunded pensions have doubled down on their riskiest strategies. Instead of de-risking, they have moved further out on the risk spectrum, employing dangerous levels of leverage and complex derivatives. They are essentially taking out multi-billion-dollar margin loans to gamble on a market recovery. This is not investing. It's a trip to the casino with retirees' life savings. This strategy has the potential to amplify future losses exponentially. A significant market downturn wouldn't just cause a decline. It could trigger a complete wipeout, leaving the fund with nothing. The official $7 trillion figure, as shocking as it is, likely understates the true depth of the crisis. That number is still based on the same rosy, unrealistic return expectations that created the problem in the first place. If you were to apply more realistic, historically sound assumptions about future market returns, say 4% or 5% instead of 7%, the funding gap would swell to double or even triple that size. The hole is far deeper than anyone is willing to admit publicly, because acknowledging the true number would trigger widespread panic and a political firestorm. The next market correction isn't just a little bump, it's going to be a game changer for many funds. It'll pull back the curtain and show just how shaky those pension portfolios really are. Those stable, private asset values, they'll crash to reality, exposing huge losses that have been buried for ages. Funds will face a liquidity crisis, forced to sell their best public assets at rock-bottom prices to meet cash needs, creating a downward spiral. The illusion of stability built on outdated valuation methods will shatter, revealing that everything was just a self-serving fantasy. This entire disaster was enabled by a cottage industry of pension consultants and asset managers who profited handsomely from the complexity and risk. They earned billions in fees by recommending these exotic, high-risk, high-fee strategies, all while shifting the long-term risk of failure onto the shoulders of future retirees and taxpayers. For them, it was a heads-I win, tails-you-lose proposition. They collected their fees regardless of performance, creating a perverse incentive to chase trends and recommend risky bets, knowing they would be long gone before the consequences came due. This is not a theoretical problem for the distant future. It's happening right now. In major economies like the United States, the United Kingdom, and Japan, massive pension deficits are already exerting immense pressure on government finances. The UK nearly experienced a complete financial meltdown when a sudden rise in interest rates triggered a crisis in its pension system, forcing an emergency intervention from the central bank. In the US, states like Illinois and New Jersey are already functionally insolvent, with pension obligations consuming an ever larger share of their state budgets. This is the endgame, playing out in slow motion. The coming decade is almost certain to bring a wave of painful pension reforms, brutal benefit cuts, and potential state interventions and bailouts on a scale never before seen. The social contract that guaranteed a dignified retirement in exchange for a lifetime of work is being torn up. Younger generations are now paying into a system that they have little chance of ever benefiting from. They are being told to expect far less than what was promised to their parents and grandparents, and in the worst-case scenarios, they may receive nothing at all if the shortfall continues to widen and the system collapses under its own weight. The central question is no longer about how to fix the problem, but whether it's even possible. Can the global pension system survive without a massive global reset in expectations and a radical commitment to transparency? The math says no. We are past the point of incremental solutions. The promises were too big, the assumptions were too optimistic, and the bets were too reckless. A generation was sold a retirement dream built on a foundation of lies, and the bill for that deception is finally coming due.